Live from his bedroom, your presenter, Alex Craig. All right. Anyways, hopefully this is the last time we do this from our bedroom. Hopefully in this little bit of post-COVID, we can get back to normal a little bit, get back onto the office there. But in the meantime, we will be doing the Greater Lansing Real Estate Market Report, September 2020, right here from my bedroom office. We will go ahead and get started on here. All right, so our September 2020 market statistics just for the month that we saw. Our median sale price was $180,000 compared to last year of September 2019. That median was 170,000. So percentage wise, that's a 5.88% increase. So we're seeing the positive signs of the market despite COVID being relatively better than last year. We can also see that in the number of sold listings. In 2020, here September 2020, we saw 693 units sold for the month. Compared to last year, it was only 630. So that's a 10% even increase year over year change. And our inventory days, yes, the percentage number is red, but it's going down, which is actually indicative of a better, healthier market in terms of homes being able to sell and housing prices going up. So our inventory home number of our inventory of homes in days is 53.4. In other words, given our current sales rate, all of the homes on the market would sell in 53.4 days, a little under 2 months. Previously, there in September 2019, that was up at 86.4. That's just slightly under 3 months. So we've had a 38.2% difference decrease year over year. This is a significant decrease because a balanced market relatively we're going to see about 5 to 6 months of inventory, so we're going to be looking at 150 to probably 180 days. So we were already low by being at 86.4, but it's actually even worse and more problematic being at 53.4. I guess it's great if you are looking to sell your home. It's not so great if you're looking to purchase a home, just because it means houses are selling fast and inventory is low. So the options, your options, when you're looking for a house, are kind of low. You know, traditionally you might have 5 options comparatively, whereas now you only have maybe two. You know, so you have definitely a little less than half the options that you might have had or have in a balanced market. So that's on the month to month, but let's put this with a little context by looking at the September 2020 market trends over a 12-month period. This is based on a rolling 12. So every month that we add in, we drop off the last month. So looking at this, we see that our average median sale price for 2020 is $165,143.83, and that is up from 2019, where it was 155,962 and 54 cents. That's a 5.9% increase in home prices. So over the last year, we probably saw around an increase of close to 6% in terms of home values. Number of sold listings, again, this is actually down, and this can be attributed to, even though last month our number of or this month, well, in September, our number of listings sold was up compared to last year September. We're down over the 12 months, which is likely attributed to, or is attributed to, the fact that the real estate market and the state of Michigan was closed down in April, and zero sales, basically zero transactions occurred during that time. And you can see that if we look over here in the right chart with this bottom dip here. That's the number of homes that sold in that month there in April and May, when the government shut down, or the state of Michigan. There were no home sales happening. So despite the shutdown, though, to me it's a relatively low number. The fact that we're only down 6.7% when it comes to the number of homes sold over the year. Obviously, as we move forward to the rest of the year, I think this data is going to kind of obviously be normalized out. The impacts of COVID will sort of disappear, and we're going to see obviously positive increasing trends all across the board. If you move down to the inventory of homes in days, again, our average over the rolling 12 is actually decreasing. It's a red number. It's negative, which is indicating that our inventory is low and our sales rate is high. So houses are coming onto the market and they're going right off the market because they're selling. So that's kind of the context that we're looking at over the last month. As you can see, we haven't had a whole huge increase here from August to September. It's pretty much stayed the same, which is typical, in seasonality. But if you do compare to last year, we actually saw a decrease usually here from August to September, and here we've actually seen a slight increase. So that's something that's kind of interesting. I think a lot of that can be attributed to how the market was pushed off later, just because of the shutdown that happened in the early spring. There was a nice summary that could a statement that I heard summary that could sort of summarize the market is that fall is the new spring, and I think that kind of captures what we're seeing here. August, September, kind of being high numbers, which isn't usually traditional. We're typically seeing May, June as our high numbers, so it's a little interesting. And then looking at the overall real estate market here for 2020, from 2019 and into 2020, we're looking at a rolling 12 here. This is in billions of dollars here, as you can see. So if we look over here in 2020, we're down slightly from where we were at in 2019, which again is to be expected because we had the shutdown. And so you might ask, is this a concern? Well, if you look over here in the chart, I don't think it is, because what I'm looking at here is the slope of the overall graph here that we can see this trend line. And then, we're going to create two separate slopes for the trend from pre-COVID, which is from here from August 2019 up until, about March 2020. And then we're going to pick back up a new trend line down here around June 2020 to about September 2020. So the first trend line here that we're looking at, which is negative, which could be indicative of the fact that, the market might be moving down, given our current trend. I just don't think that's true when we look at the R value, the R squared value. There's not a whole large um, fit to this trend line. In other words, our data and information doesn't really fit this trend line very well. It's nearly close to zero, our R squared value. So this trend line that you're seeing on the chart isn't very indicative of what's going to be in the future. Whereas if we create trend lines, like I said, for the pre-COVID and the post-COVID, we're going to have an R squared value, or a coefficient of determination that is much, much, much closer to the trend line here. And so when you're looking at the slope, we're seeing a slope in the pre-COVID that is pretty much equal to, or maybe even slightly better than in the post-COVID, which would indicate that house values and the real estate market as a whole is actually going to go up faster and accelerate faster than it was in this post-COVID or in the pre-COVID environment. So it's very interesting to see kind of how this plays out in the next coming months. But it's actually indicating that the market may continue to grow faster. And I think the question then becomes, though, is it a sustainable growth? Is the growth being, driven by maybe fear, or things like that to say, hey, let's get into this, house before, maybe perhaps the economy does go down and buying a house no longer becomes affordable or optional, or people are making these moves, or doing things that they may not necessarily do once the economy maybe goes south. So it's kind of interesting to see, what's driving, um, you know the growth to determine whether or not it's going to be sustainable. Most definitely, all we can do is continue to monitor this information and continue to look at it. But at the moment, from June 2020 to September 2020, we're certainly seeing signs of positive growth. Um, that's almost even faster than where it was in this pre-COVID environment. So I think that leads us to the next point of what you can expect depending on who you are. So if you're planning to buy, um, you're gonna have to expect your potential options to be lower than normal, and of your options, expect all of those houses to sell like quickly. So there's not going to be a whole lot of houses for you to see on the market just because they might not fit your preference and that sort of stuff. So you're either going to have a very, very small number of homes that fit your requirements, or you're going to have to significantly compromise when you're house hunting. And either way, even if it's not your favorite house, expect it to go fast. And so that can be a tough one. The only thing that I have on the bright side, if you're planning on buying a house, is that interest rates are low, which is going to make your monthly payment relatively low. So that is the good news, or the good side of this whole thing. So, and the driving force for that is, there's obviously being less homes listed than the previous years, and that's just causing a decrease in our inventory levels that are available. So, if you plan to sell, expect your home to sell fast if it's priced properly, and make sure you have plans for moving and closing quickly because it's going to happen faster than you think. Obviously, we were looking at low inventory, so your days on market is going to be short, and you're probably going to be listed and be out of the house within 60 days if everything goes well, if the market sustains, and all that sort of stuff. So the driving forces for that are low absorption rates and low inventory. And then if you're planning on holding, you're going to be a homeowner, you're not planning on buying, you're not planning on selling. So what's the big deal? Why bother with knowing how the real estate market is? Well, I think there's a few interesting opportunities that you may want to execute on. And some of those are due to the fact that you can expect your equity position to improve as home values probably continue to increase as they have over the last couple months, even in this post-COVID economy. And so, what you're going to see is that because of the increase in equity, that opens you up to opportunities for like a cash out refinance, which you could use that cash to say, pay student loans down, start a business, refinance other, maybe have high interest credit card debt, and you're able to refinance out, cash out your refinance mortgage at a super low interest rate, 3%, 2%, 4%, which is way better than if you're paying, 16, 20, 25, 27% on a credit card. You could also extend that line of credit, a home equity line of credit for, home repairs or those sorts of things. You definitely might want to consider it. Of course, you'll have to look at all of your finances. You'll have to get approved by the bank in order to be able to finance that amount. If your income is relatively the same or stable, to see if you're able to afford that mortgage payment that would occur, or that you would have increasing by your cash out refinancing, or adding a home equity line of credit. But it definitely may be worth it to you. So, and if you plan to rent, rents are probably going to continue to increase as the cost of homes goes up. Investors are going to continue to need to increase the rent in order to achieve cap rates, capitalization rates, and positive net operating income on them. So, because they're acquiring these properties at higher amounts, is going to mean that you're probably going to pay a higher amount. So it's going to be interesting in terms of what the future is going to hold. If whether or not all this economy and the house prices are being propped up by the election. Elections always have an impact on markets and economies, so it'll be interesting to see how everything responds after the election here in November, which is about a month away from the recording of this video. So, with all that said, if you're planning on buying a home or selling a home, get in touch with us. We'd love to see how we could help you out. We offer free home value analysis to see what your home might be worth and if it might make sense for you to sell. We also offer free consults for home buyers to see if we might be a good fit and see how we could help you out and see if you could get approved there for a mortgage. So give us a call at 517-244-6044 or go ahead and visit us at dolinskigroup.com to learn more about us or get in contact with us, and we can certainly help you get set up with an agent today.